What I thought I might talk about this morning, given the short time that we have together, is year-end tax planning, given that we're fast approaching the tax year end of 5th of April. What I will say is going to apply equally, of course, to opportunities for the next tax year. I also thought I might cover, if we have time, the subject of DB transfers, that's transfers of accrued pension rights from an occupational final salary scheme to a money purchase personal pension plan, given the recent, or relatively recent, tax freedoms and flexibilities. Starting then with year-end tax planning, I thought it'd be helpful just to provide a few financial planning suggestions for you to think about. Of course, everyone's tax situation is different, so it goes without saying that before implementing any of the strategies, you should seek professional advice. Effective tax planning, in my mind, is knowing and understanding the taxes you are liable to pay and acting to minimise those taxes, of course legally. It's also about maximising net income and creating opportunities to invest and save tax efficiently. Whilst there's no doubt that the tax system is complex, you should not let complexity deter you from the simple goal of maximising wealth generation and retention and keeping your taxes as low as possible. So if we touch on a couple of thoughts, looking first at personal allowances, my message is quite simple. Ensure where applicable that each spouse uses their full personal allowance for income tax purposes. Annual income of less than £11,000 currently, £11,500 from next year, is not liable to tax. Spouses and registered civil partners should therefore consider the possible transfer of income producing assets to ensure that personal allowances are not wasted. Marriage allowance is also something that you might want to look at. This lets you transfer £1,100 of your personal allowance to your spouse or civil partner if they earn more than you. This reduces their tax by up to £220 in the tax year. To benefit as a couple, the lower earner must have an income of £11,000 or less. There are also a number of tax favourable investments out there, which, if appropriate to your particular situation, you should certainly look at. The most common, of course, and the most well known is ISAs, individual savings accounts. There are, of course, others, enterprise investment schemes, seed enterprise investment schemes, and venture capital trusts, and the use of these should be reviewed, certainly if appropriate to your personal circumstances. If we perhaps take the simplest, the ISA, as you may know, up to £15,240 per person, so that's £30,480 for a married couple, can currently be invested in an ISA for the 2016-17 tax year. From next year, the limit in fact is £20,000. So I would urge you to make the best use of ISAs, because the income and capital gains on ISA funds are essentially tax-free. So as they say, use it or lose it.